Hello, welcome to the new chapter. This chapter is about cash flow and financial planning. In this chapter, our learning goals are um, first, we are going to look at understanding tax depreciation procedures and the effect of depreciation on the firm's cash flows. Primarily, we will deal with only one procedure, one depreciation method only. Uh, then we will discuss the firm's statements of cash flows, operating cash flows, and free cash flow. These are very important inputs to financial analysis. Finally, in this part of the presentation, we will try to understand the financial planning process, including long-term strategic financial plans and short-term operating financial plans. The rest of the three learning goals will be discussed in the next part of the presentation. So let's begin with the first one. Let's discuss firm's cash flow. Now we will use the term cash flow instead of accounting profits. And this is because cash flow provides a firm's cash position versus accounting profits, which actually depends on accrued uh, accounts. For instance, sales expenses that have been accrued and not yet received or paid and has been recorded in the accounts. That does not give us the exact position of cash. So we look at two different perspectives of cash flow. The first one is accounting perspective. The cash flow is summarized in a firm's statement of cash flow. And the second is financial perspective, which is more about the how to use the statement of cash flows. So this is more about the use of financial perspective. Now, how it can be used. A part of statement of cash flow, which is called operating cash flows, is used by the managerial is used for managerial decision making, and an analytical uh, outcome of firm's statement of cash flow yields to uh, free cash flows, and this free cash flow is closely monitored by participants in the capital markets for various reasons, and we will see that free cash flow is used a lot. In fact, it is the most used term when when calculating the firm's cost of equity, or and this is an input in many different models that we will see in the future's presentations. So first we discuss the concept of depreciation. Depreciation is the portion of the cost of fixed assets charged against the annual revenues over time. Depreciation for tax purposes is determined by using modified accelerated cost recovery system. Now this is what we are going to use in this book or in this session. Uh, we already know that there are other methods as well. For instance, straight line method, we have double declining balance method, we have production units of production method, and then we have sum of year digits method as well. Sum of year digits methods as well. But here we will continue to look at modified accelerated cost recovery system, in short called MACRS. Now let's look at an example, and while we will go through the example, we'll understand the entire concept of MACRS. Now BC acquired a new machine at a cost of $38,000 with installation cost of $2,000. Now please understand that in MACRS, installation costs are part of the machine. So this becomes total cost of $40,000. When the machine is retired from service, BC expects that it will sell it for scrap metal and receive $1,000. Now there could be this is what we call salvage value. Let's calculate what is the depreciable value of the machine. Now there are a few things that we need to know about MACRS. Now Under the basic MACRS procedures, the depreciable value of an asset is its full cost, including outlays for installation. So that is the first thing that you have to remember. The second is there is no adjustment is required for expected salvage value. Unlike straight line methods, it's easier. The third is for tax purposes, the depreciable life of an asset is determined by its MACRS recovery predetermined period. And that's what we'll look into the next slide. MACRS property classes and rates are shown in the next slide. Let's look at only 4 categories have been discussed here. Now, property class is those properties which falls in 3 years, those which falls in 5 years, 7 years, and then 10 years. You can see in 3 years there is mostly research equipment and certain special tools. With 5 years we have computers, we have qualified technological equipment, etc. And 7 years we have more fixed machines or bigger machines, for instance office furniture, fixture, manufacturing equipment, railroad track, single purpose agriculture and horticulture structures, etc. Then in 10 years recovery period, those are long term assets, for instance equipment used in petroleum refining or in the manufacturing of tobacco products and certain food products, etc. So this is the max 4 property classes, first 4 property classes and their recovery years and recovery rates. So this is the recovery year and this is the recovery rates that are given in the under the table. Now you see we have percentage by recovery year, that is 3 years, 5 years, 7 years and 10 years. And you can see that the recovery years goes till 11 years. Now why it's 3 years but ends in 4 years? Ends in 4 years. Now in order to understand this, you have to remember that under MACRS there is, if this is first year and then second year, then third year. So MACRS, by virtue of the essence of the method is that it starts half yearly. So it starts if you buy it year beginning of the year 1 or at the end of the year 1, it will always assume that the machine has been bought at the middle of the year, at the midpoint of the year. So midpoint of the year, and so this is for 6 months only. Hence there will be an extra 6 months at the end of the year, which means it will enter into the 4th year. And so we have this 7 here, or in the last here it will come as 5. You'll see it's extended by 1 more year. So for first year it is 33% and the rest of it is charged, we can say that it is extended to the last year, that is 4th year. Another property of this method, you can see that a large amount of depreciation is charged at the beginning of the years, while a small amount is charged in the later years. And um, so let's look at the solution of the question. So BC acquired for an installed cost of 40,000, as we discussed. 38,000 was the cost of the machine, 2,000 was the installation charges. We added up, which is 40,000. So machine having a recovery of period of 5 years, using the applicable MACRS rates and the depreciation expense each year is as follows. So the cost of 40,000, and this is the rate 20% for the first year, and it is 8,000 charged to the asset. And so the total amount is fully recovered in 6 years. You can see this is the first 6 years, and this is how we calculate the depreciation under MACRS. Now let's look at the statement of cash flows. How to develop this statement? We will first look at the components of this statement. So every cash flow statement has three main components: operating cash flow, investment cash flow, financing cash flow. So operating cash flows which are directly related to the sale and production of firms' products and services, while investment cash flows are associated with the purchase and sale of both fixed assets and equity investments in other firms. While um, financing cash flows, these cash flows are uh, results from debt and equity financing transactions, including incurrence and repayment of debt, cash inflow from the sale of stock, which is important that you should remember that it comes under financing flows, and cash outflows to repurchase stock or pay cash dividends. So we'll go through this whole statements. Let's look at the snapshot of how inflow and outflow of cash works. So we always begin the cash flow statement with net profit after taxes. We always add back depreciation and other non-cash charges. And after this, we have the other account represents either inflows and outflows. And this is shown by these inflows are from sources and outflows are also called uses of funds. So sources means we receive money. So inflow, whenever an asset decrease, it means the asset has been sold and the money came back to the firm. In return, they get the money. And so increase in any liability means that the accounts payable or notes payable has been created, and against this account we have received certain cash. Same is the case with the sale of stock. When we sell the stock, we receive the money. If increase in any asset happens, then it's opposite to this. We bought the asset, the money went out of our pocket, and hence we will have little cash. Similarly, increase in liability, if it's decrease in any liability, we paid back the accounts payable and the notes payable. Hence, we have um, our cash balance falls. And we have to also look at the net loss and dividends paid. They are all causing outflows and repurchase of or retirement of stocks. So this is the income statement of the PC company 2015, and you can see that this is the sales revenue. It begins, then we have all the operating profits, and then we have earning before interest and taxes, then net profit before taxes and net profit after taxes. Now this is the figure from which we are going to begin our cash flow statement, and we are going to then use others as well, uh, other accounts as well, to adjust it. Similarly, in the balance sheet we have all the changes. So we have 2015 and 2014, and we have to see that whether this increased or decreased. Similarly for the fixed income, and in fixed income, when we are going to calculate the investment, we are going to use the gross fixed assets at cost and not the net. Let's look at the liabilities and stockholders equity. Here also we will be looking at the change between the two the 2 years, that how it is increasing or how it is decreasing, and that is the long-term debt from 400 to 600. So remember, this is 2015 and this is 2014. So we are looking in this direction, that how they changed. Preferred stock, and we have to look at these accounts. Let's this is the cash flow statement, and the cash flow statement begins with the net profit after taxes, which is $180. Then we add back the depreciation, which is an income statement for $100. Decrease in account receivable, you can check by calculating the change. It is $100. Inventories, accounts payable, and then you see the decrease in accruals, which cause a minus sign of $100. So cash provided by the operating activities is $780. Then from investment activities um, we have we have increase in gross fixed assets and changes in equity investment in other firms, which is zero. So the cash provided by investment activities is around $300. Cash flow from operating activities is again cash flow from financing activities is notes payable, long-term debt, stockholders equity, dividend paid, and cash, and all signs corresponds to either uses or sources of cash flows. I would strongly suggest you look at the balance sheet and income statement and read and try this example all by yourself and match your answers. And the net increase in cash and marketable securities of 500 is actually should be equal to the difference between the 2 years cash balances in the balance sheet. In the balance sheet. So in 2015 it's 1000 and in 2014 is 500. So the difference is the same as this one. Now how to interpret statement of cash flows? And this interpretation is actually pretty simple. The statement of cash flows ties the balance sheet at the beginning of the period with the balance sheet at the end of the period, which we have shown just in the last slide, after considering the performance of the firm during the period through the income statement. Now, this is the second thing that we have to look at is the net increase or decrease in cash and marketable securities should be equivalent to the difference between the cash and marketable securities on the balance sheet at the beginning of the year and at the end of the year. And we saw that was 500. If you remember, again, I will write it. It's 1000 in 2015 and 500 at the beginning of the year, and the difference is 500, which is already which we established through statement of cash flows. Now let's look at uh, operating cash flows. Now this is very important, that operating cash flow is the cash flow a firm generates from normal operations, from the production and sale of goods and services. In financial statement, how does it looks? So it's a net operating profit after tax equals to earning before interest and tax, which is also called operating profit, and this is the tax. 1 minus tax is we apply the tax. Now if we know that add back the depreciation, we will get operating cash flows. So the only non-tax item before EBIT is depreciation expense. Hence, if we add back, we will be getting an operating cash flow. So this O is now just operating, and it's not it does not have any non-cash expenses. So depreciation is being added back here, and if we merge the two equations together, we will get this one. Operating cash flow equals to operating profit, net operating profit after taxes, and plus depreciation. So this will give us operating cash flows. In our example of BC Corporation, our operating profits are, so I'll do it here. So they are, we have EBIT of 370, and we have $370. Then we have 1 minus tax, which is 40%, and then we have the depreciation expense of $100, which is non, so we add back and we get equals to $322. This is what we have for the BC Corporation as operating cash flow. This is very important part of analysis, because probably many of the because managers are very much interested in operating cash flows on a day-to-day basis. Hence, you should familiarize yourself with this process, um, um, so that you can do well in this. Then comes the concept of free cash flow. As I said, almost all the models in finance, especially at this level, will require free cash flows. And there is a concept, and there is a reason why it makes sense. Because free cash flow is the cash flow that is available to investors. Investors includes both creditors and owners, which means stockholders and bondholders both. After the firm has, after the firm has met all operating needs and paid for investments in fixed assets and net current assets. So they have done everything, and now they have paid for everything, and what is left is for these uh, two investors, creditors and owners. That's why free cash flow is very important. Um, and is calculated as simply operating cash flow minus, so you have net fixed asset investment and net current asset investment. So net current asset investment will come, is both are pretty simple to understand. Net fixed asset investment is change in net fixed assets plus depreciation. Now you know the net, we have removed the depreciation, so we have to add back the depreciation and convert this into a gross figure. This is because we have already added back depreciation here in operating cash flow. And in this net current asset investment, we will see the changes in current assets, which means cash and marketable securities and account receivable, etc., and minus change in accounts payable plus accruals. So this is a change. Change means it's a year-to-year change. So it's something like this: t minus 1, so which means that the change from the last time period. You can see the example for BC Corporation. NFI comes out to be 1200 minus 1000 plus 1000, which is equal to 300, while net current asset investment comes out to be the 0. So total FCF is $22. The free cash flow, the firm generated adequate cash flows to cover all of its operating cost and investment and had free cash flow available to investors. But there is a problem for $22, means $22,000, because the firm has a larger portion of debt, and they should have generated more free cash flow to deal with that debt, which is around $70,000. So they should be looking forward to working on increasing the FCF, or free cash flows. Now, the second part of this presentation is about the financial planning process. It is important to understand how the entire process works. If you understand this, it will help you to develop the capital or cash budgets, and also will help you to develop pro forma financial statements, which is kind of a projected financial statement. Let's look at the financial planning process. Now, the financial planning process begins with long-term or strategic and financial strategic goals. Financial plans that in turn guide the formulation of short-term or operating plans and budgets. So it's pretty straightforward that you must have a long-term plan, vision, strategy, and then you will have pieces. You will bifurcate into short-term plans, and short-term plans includes all these budgets and operating plans. So two key aspects of financial planning are cash planning and profit planning. So we will look into this. cash planning involves the preparation of the firm's cash budget, and profit planning is pro forma statement. So first we will look at cash budget, how we will build it, and then we will look at how to build the projected pro forma statements to calculate the profit. The financial planning process begins with long-term strategic plans. They range to around 2 to 10 years, and firms that are subject to high degrees of operating uncertainty can have relatively short production cycles, or both to tend to use short-term planning horizons. So um, there is no fixed rule of what is really long run or short run. It depends on the company, its business, its core business, and its strategic plan. Strategic plan is always a long run vision type of a plan, and then there are short plans which are met as kind of targets, and once we meet those targets, we go on meeting, finally we can achieve a long run strategic goal. So these plans are only one component of company's integrated strategic plan, and there are others as well. So long-term plans includes a number of financial activities. What are these? For instance, you can see these are proposed fixed asset investments. We want to invest after 5 years another plant, machinery, or we want to replace a plant and machinery, or there will be a maintenance projects after 3 years, etc. We would want to have a research and development activities, especially in pharmaceutical, you can see, or in other areas as well, that especially in technology, you can see the research and development activities are almost um, on a daily basis going on and are planned. Marketing and product development, this is also part and parcel with the research and development activities. Capital structure, how and what kind of a capital structure will be required at different stages of the corporation, and from where the money will be arranged, sources of funding. These plans are generally supported by a series of annual budgets and profit plans. Short-term operating financial plans specify short-term financial actions and anticipated impact of those actions. So short-term, less than 1 year. Key inputs includes the sale forecast or operating and financial data. We can have a key output includes operating budgets or cash budgets, pro forma financial statements. So these are the cash budget and pro forma financial statement is obviously the natural outcome of short-term plan, because we want to see where we are, how we will go forward, what we will get. And when the pieces are summed together, we can have a long-run plan. You can see that this is the graphical depiction of short-term financial planning. You can see that there is information that is required, or the output for analysis is required. So we always begin with the sales forecast, and from the sales forecast we go to the production plans. This leads to the income statement, pro forma income statement. Pro forma is the projected income statement, and then we have current period balance sheet. We take this information and start working on pro forma or projected balance sheet. This comes from the the production. So the long-term financial plan goes into the, this information is required, what we are going to do with the long-term financing plan. For instance, change the machinery, replace it, or extend the plant to a new plant, etc. What kind of a asset outlay we need. This information, once provided, will help us to project the cash budget, and this cash budget ultimately goes into pro forma balance sheet. Also, this long-term and fixed asset goes independently into the pro forma balance sheet as well. So there are many structures that you will see available everywhere. How short-term financial planning is done, this is a generic version. However, this is not a rule, and there could be different ways this can be changed. It's very flexible, and you can look into this, especially if you are doing any project. It will be easier for you to understand that these things can move around. So with this, we finish our first part of the chapter, and that is the learning goals that we covered were related to tax depreciation procedures, especially with the We discussed the MACRS, and then we have discussed the firm's statement of cash flows, in which operating, investment and financing activities, and we also discussed how to calculate the operating cash flows and free cash flows, FCF. Uh, this is important that you should always remember that these two are kind of analytical tools that should be available with you all the time. Finally, we have understood that what is the financial planning process, what's the difference between long run and short run financial plans, and how long run can be divided into pieces, into short run plans. And then short run plans are a variety of plans, including the cash budget and pro forma statement, which are projected statements to calculate the position of cash and profit of a company. Thank you.